In the last few hours, silver didn't dip, it got executed. We just watched silver price fall from the Tuesday rebound zone near $78 to an intraday low around $70.31, and now it's fighting for its life at $72. And here's the part that should make your stomach drop. This wasn't bad vibes. This was a mechanical sell-off, a forced liquidation event with a clean three-part trigger. So if you're sitting there thinking, was that the top? Or is this manipulation? Or should I buy the dip? Hold that thought, because the only thing that matters right now is this. Was this selling voluntary or forced? If it was forced, the story isn't over. It's just changing chapters. New Year's Eve, thin liquidity, everyone's trying to close books. Silver had one of the most violent years in modern commodity history, massive annual gains, record highs, then year-end suddenly hits and the market flips into survive the close mode. Today's tape is the definition of that. A sudden collapse into the low 70s, a scramble to hold $72, and a market that's acting like it just stepped on a landmine. This is not a normal day. This is a system day. The why behind the 72 massacre, the perfect storm. Force. 1. The CME Margin Hammer, the leverage kill switch. Let's start with the one thing most people refuse to understand. Sometimes price doesn't move because people change their mind. Price moves because the exchange changed the rules of oxygen. CME raised performance bond requirements, margins, for silver futures, and in the official notice, the COMEX 5000 silver futures SI margin line shows initial around $25,000, up from $22,000, effective after the close of business December 29th. Now, if you're not a futures person, listen carefully. A single COMEX silver contract is 5,000 ounces. So when silver is $75, that's $375,000 of metal exposure. Most retail traders don't have $375,000. They have margin, a performance bond, collateral. So what happens when CME raises that collateral requirement? It's simple. If you have extra cash, you post it. If you don't, your broker says reduce risk now. And if you can't reduce risk fast enough, you get liquidated. This is why margin hikes are not news. They're not sentiment. They're a forced deleveraging mechanism. And it hit into year-end conditions, when liquidity is thin and desks are already trying to flatten risk. Multiple outlets reported this margin hike as a key driver of the sharp drop because it pressures leverage positioning at exactly the wrong time. Now here's where it gets nasty. A margin hike doesn't just make some people sell. It forces selling from the most fragile part of the market first. Who's fragile? Over-leveraged retail, oversized swing traders, anyone who added on the way up and was fine until rules changed. And that's why these events look like a massacre, because the market isn't politely selling. It's closing positions at any price. Let's make it real with dead simple numbers. Imagine you're a retail trader. You have $35,000 in your account. You're trading one silver contract. Before the hike, margin is around $22,000. You've got a cushion. Then CME hikes it to around $25,000. Now your cushion is smaller. Then price drops. Your unrealized loss grows. Then your broker says, post more collateral. And if you can't, you don't get to debate it. You don't get to philosophize. Your position gets sold into the market. Now multiply that by thousands of traders and risk desks who all get the same message at the same time. That's the hammer. Force 2, the 7250 technical trap. Now let's talk about the second force, because this is where the drop stops being human and becomes robotic. There's a reason the selling accelerated when we lost the 72-ish area. In today's trading range, silver price was moving inside a wide intraday band, down into the 70.5 area before bouncing near $72. Here's what happened structurally. Traders were watching a key support zone, around 72.50, low 72s. Once price broke through that zone, it triggered stop-loss clusters. Stops are market orders. Market orders don't negotiate. That wave of forced selling pushes price lower, which triggers more stops. And then bots do what bots do. They don't feel fear. They detect momentum plus liquidity. So they flip from buy the dip to sell the break. This is why the move feels like falling down an elevator shaft, because once the trap door opens, selling feeds selling. Force. 3. Year-end profit booking plus close the books. Flows. Now the third force is the one that makes this perfectly timed year-end positioning. This is the part nobody wants to admit because it ruins the romance. Silver had an extraordinary 2025, huge annual gains, record highs, then into year-end it pulled back sharply. And what do big funds do on the last days of the year? They don't sit around chanting diamond hands. They do three boring, brutal things: lock in performance, reduce headline risk, show cash, reduce volatility on the statement. Because if you're a fund manager and you just had an epic year in a volatile asset, you don't want to explain a giant drawdown that happened after you could have closed the books. So what happens? They sell winners, they book profits, they trim risk. Reuters explicitly noted year-end profit-taking as a driver of the pullback across precious metals, with silver falling sharply from its highs into year-end levels around the low $70, so stack it together. Margin hike forces leverage out, technical break triggers stop cascade, funds book profits into year-end. That's not one wave, that's three waves, hitting at the exact same moment. There's a moment in every mania where the market stops asking, is this healthy? And it starts asking, how do I get more exposure? That's when leverage sneaks in. That's when risk controls matter more than fundamentals. And then one day, the rules change, liquidity thins, or a support level breaks. And the market teaches everyone the same lesson at the same time. That's what today is. Not a debate. A lesson. Because a move like this doesn't politely remove weak hands. It clears the room. What $72 actually means, price versus behavior. Now, here's where most people get trapped. They stare at a number, $72, and they treat it like it's magical. But $72 is not magic. It's a headline handle, a psychological number where humans start talking. The real question is behavior. Did the market bounce because liquidation ended? Or did it bounce because real buyers stepped in? And does it hold or fade? Because if this was forced selling, you often get a rebound when the forced selling stops. But if this was discretionary selling, funds choosing to reduce risk, then bounces can be sold again, so you don't watch one candle. You watch the character of the tape. Here are the signals I'm watching over the next sessions. Signal 1, does silver stop acting thin? Thin markets create freak wicks, exaggerated drops, violent rebounds. If price action stays chaotic, it means positioning is still unstable. If it starts acting thicker, less whip, more orderly, then the forced phase is cooling. Signal 2, does it hold above the intraday reclaim zone? Today's range shows the market traded down near the low 70s and is fighting around $72. I'm watching whether the market can build acceptance above the bounce zone, not just tag it. A real recovery holds ground. A dead cat bounce gives it back slowly. Signal 3, does the market respect support or slice it again? If $70 breaks again cleanly after a weak rebound, that tells you the selling is still in control. If $72 holds and rebounds with stability, it suggests the worst liquidation passed. Signal 4, watch the reaction, not the opinion. The internet will scream, buy the dip. It's over. Manipulation. Ignore the shouting. Watch the behavior, bounce quality speed of recovery, whether dips are bought immediately or sold lazily. The three possible next moves, what comes after a flush. Path A, the V-shape, liquidation end. Snapback. This happens when liquidation finishes, selling pressure vanishes, price rebounds violently. You'll see sharp bounce, higher lows, quickly sellers can't push it back down. Path B, the dead cat bleed. This happens when funds are still trimming risk. The bounce is mostly short covering, real demand is cautious. You'll see bounce, then slow fade, lower highs, repeated selling into strength. Path C, the grind. New range, new game. This happens when leverage got cleaned out, but the market is still strong longer term and both sides reset. You'll see choppy sideways action, lower volatility, gradually clearer, support resistance forming, no prediction. Just scenarios, so you're not surprised.